Welcome to your weekly market update where we talk about everything mortgage and real estate related. I apologize for not being on last week. I was out sick, but I'm back at it with a lot of great information for us to talk about today. So we have some amazing news on interest rates. We've seen them drop by over 0.5% from just last week. And this is primarily due to the banking crisis with Silicon Valley Bank and then Signature Bank failing. It's created a lot of fear in the market. And when it comes to fear, a lot of investors take their money out of the stock market and put it into the bond market, which then helps interest rates. Due to that, applications for mortgages are up 7.3% from last week. And again, that's due primarily to the drop in rates. 10-year note, the 10-year Treasury note has dropped from a height of 4.02% on March 9th, so just last week, to a low of 3.42% today. So that is over 0.5% drop in the 10-year note just in the last couple of days of trading. Retail sales are down 0.4% in February, which was below the expected number of 0.3%. This is just showing a little bit of crack in the economy. People are not getting out there and spending as much as they were the months before. And then the Producer Price Index, which measures wholesale inflation, was down 0.1%, which was below the expectation of a gain of 0.3. So year over year, that number has decreased from 5.7% to 4.6. So that's really good for inflation numbers and signs of what the Federal Reserve will do in the future. Year over year, Core Consumer Price Index, which is the number one indicator of inflation, decreased from 5.6 to 5.5%. So we're seeing improvement in inflation that will help interest rates and the Federal Reserve making their decision to stop or pull back and even possibly decrease the Fed fund rate in the near future. The banking crisis that we're seeing is spreading to Europe now. So that's why today you're seeing the stock market really take a beating. So we're not the only ones being affected by the banking crisis and the increase in interest rates. The overseas markets are also feeling that as well. So this is all good for interest rates because uncertainty and fear in the stock market is always good for the bond market, which is where mortgages are from. Some fun facts I want to talk about. This is really cool. So if you're looking back at history of the housing prices from 1941 to today, home values over that entire span of time have increased 73 years, has only decreased 7 of those years, and have been flat for only 1 of those years. That's a pretty good record that you do not want to bet against when it comes to housing. And the concentration of those losses was during the housing bubble, where there was wild speculation, not enough demand, and a glut of supply. So this could not be more different than the market that we're in today. Don't bet against real estate. Don't bet against the champ. As you can see, real estate pretty much always goes up, and you can't fight the data. So give me a call if you have any questions. I think right now is a great time to still get out there while interest rates are below where they were just last week. I would love to talk to you about what your options are available and how we can help you. Give me a call at 847-942-1497 and have a wonderful day. Bye.